Good morning. It is Monday, February 2nd, 2026, and this is your Clubhouse Insider. Last week was actually very surprisingly uneventful. Even with a Fed policy decision being announced that rates are going to stay put, and President Trump nominating and announcing his nomination for the next Fed chair. A lot of people expected volatility, but we didn't get it. So as you can see here, rates are holding steady just like the Fed did. And the Fed, basically the market shrugged it off because most of this was already priced in. The bond market, which drives mortgage rates, had already adjusted its expectations. So rates are still hanging around pretty close to where they were this time last week, with FHAs down here in the upper fives, conventional just over 6%. And you can see just kind of the chart here as we look. If we want to go back to January 2026 to start the year, you'll see that we're pretty flat. So the biggest takeaway is that mortgage rates are really not expected to just drastically fall from here. Most experts and analysts have rates sitting right in the range where we are now for the near term. Could we see small improvements? Yes. But the idea that we're suddenly just going to drop even lower, especially into the low fives or even fours without some kind of major economic shift, is pretty unlikely. So that matters because the market is giving opportunities right now. So if you're sitting at a 7% or higher, or especially FHA in the upper sixes, or if you bought in the peak run-up in the last 2 years where the rates were higher, if you're coming out of a temporary buy down, or if you're in one right now and it's about to adjust to the higher rate, or if you're carrying high consumer debt impacting your qualification, like personal loans, credit card loans, anything of that nature, there's opportunity to improve your overall payments, your total cost, all your debts going out versus things, money, income coming in. So if we can do that, if we can improve your overall payments, if we can remove mortgage insurance potentially, we can shorten your term, if that's your goal, is to pay off the house, or we can consolidate your debt, that's real money the market is giving you today. So waiting for a perfect rate environment that may not come could actually cost more than acting strategically right now. So for buyers, stability with these markets is a gift. When rates aren't spiking, there's opportunity to negotiate. You can structure deals, and you can refinance later if we get even further improvement. But the key is rates are in line with where experts expect them to be. So the window is open right now. If you bought knowing that you were going to refinance in the near future, we are now in the near future. So if you're close to 7% or above, especially conventional, if you're FHA in the mid sixes or higher, it's time to run the numbers and see if we can get those savings that you originally talked about when you first started looking into purchasing the home that you're in now. So don't guess, check your work, and let's make a smart move. And lastly, we are 8 days away from pitchers and catchers reporting to spring training. So hopefully you're getting excited. Cold weather will be behind us shortly, and we can really run into this spring season where I think it will pick up. I think buyers and refinances are really going to start going up. And so do a quick Google search yourself, though. Check my work as well. No one's expecting anything crazy to happen. So this is just Google AI. You can just type in mortgage rate news, and forecasts, they're right here. We're going to hover right around where we are. So if you're expecting the markets to come down, it's possible with some political stuff, like the new Fed chair, if he comes in and kind of shifts things up and the markets react to that. But there's just so much to it that most people that study this in and out every day are saying they're going to hold still. So that's the insider for today. Call me. Let's take advantage of some opportunities. The market is giving money right now. I'm seeing way too many people say $500 a month in savings isn't enough, and they're looking for more. I think that's a mistake, because I don't think that there is going to be any more for another year or more plus. So take those thousands of dollars now that they're going to give you through the market from the year, and let's see what happens. So have a great week and look forward to talking to you.